it just felt like it was
and
update.
you know, Prashant,
You've got to do this when you do that.
and you know, Prashant, in markets, we talk about fundamental technicals, fundamentals, everything. But I think sentiment plays a big part.
Oh, 100%.
You know, on just when you have some bit of confidence back, I think markets react that way. So I guess that bit of sentiment is back, bit of that confidence is back. So, you know, same time last week, the feedback was there was extreme pessimism and fear in the market. I think from that extreme pessimism and fear, there is a bit of relief or a hope in this week.
So the question is, what next, right? Does this pullback have more legs to go?
I mean, so let's look at the global and the local data, and that's what I'm going to do. Let me just hop across to the big wall to explain. What I'm going to do is first start with the global, but this is essentially how I'm kind of putting this out. Does positioning indicate that there is perhaps a chance for a meaningful bounce, right? That's the question. So this is just kind of recapping how the mood in the market has changed. These are the three biggest things we track every morning when we start, the bazaar, the morning show. And look at this. In January, the sentiment was that we'll land very softly. I mean, it'll be a gentle landing. There will be no hard landing. Things will be okay. Things will work out, right? The S&P went up 6%. The 10-year went down 35 basis points. The dollar was down 2%. In 1 month flat, because of the data, very hot data out of the US, which is jobs data, services PMI, jobless claims, and many others, all in the last 1 month, it became from soft landing to no landing. What do we mean by no landing? That the economy will continue to do well, which means that the Fed will have to fight a longer fight. And this is what happened as a result. It completely flipped. The +6 became -3.7, -35 became +45, and the dollar from -2 went up 2% plus in the month of February. And we are starting March now, pretty much continuing where we left off in February. Data is still strong, right? And this is the worry, really. This is the main worry for global markets. This is the US 2-year yield. And, this has got data all the way back going 2006. And as you can see, it is broken out. It is broken out of some significant levels, and it is surging. Now, and I could have put out sort of charts for the 10-year. It'll give you a similar kind of picture. Across tenors, basically 5-year, 10-year, 30-year, across the board, yields are surging. And this is not good news. Let me just tell you what the worry is. The worry is if we are going to see a regime of higher for longer, which is rates go up and they stay up for longer, it leads to the following, in a way, negative externalities, right? There is demand destruction, which is negative for companies. Margins are hurt. There is higher interest cost for levered assets, especially things like real estate, etc. And there are asset write-downs and credit losses as well. Just this week we saw, trouble at a Blackstone fund, right? So this is what this is the cost of higher for longer. If we are to see that, this is what the market fears. Now let me tell you the other side, why many are saying that perhaps there is hope. What is the hope? Some of it is technical in nature. First of all, like any market, the rates market in the US is also looking extremely overbought. Across tenor, 2-year, 5-year, 10-year, 30-year, things are looking very, very overbought, oversold, depending on what you look, which means that it could limit the significant further upside, at least in the near term. So the 10-year is at about 4%. Is it possible because of these conditions we see a pullback? I would say yes. The other thing, this is the technical reason, the breakout in the 2-year yield has not yet been confirmed by the 10-year or the 30-year. So sometimes these things matter. All right, it's not as if the entire yield curve is pushing higher with the same ferocity. The Fed's terminal rate pricing remains a moving target. It's, of course, dictated by data. You just need 1 or 2 weak economic data prints to show that things are cooling up a little bit. The economy is cooling up a little bit, and it'll be back to sort of, the soft landing environment I described, which was prevalent in January. So it doesn't take much to change the sentiment. Now, let me just quickly get to the local data point, right? The numbers tell you everything. So what I've done is I've taken what FII net short positioning in the market is. You can see 4 instances. The last one is now. As of yesterday, the net short position of FIIs was about not 1.34, 1.31 lakh contracts. You look at the previous instances, October 2022, 1.37, June 2022, 1.46, and May 2022, 1. all of it about more than 1.2 lakh net short contracts. This is the change 30 days later, right? June, of course, June and October were more significant. And this is 60 days later, 2 months after this, what happened? As you can see, markets in all three instances rallied to varying degrees. The question is, we already, by the way, have today's rally, which is about 1.5% or so. What next? Could this become bigger is the question. I mean, I reckon the mood is negative. People refuse to believe that perhaps we will see a big global, we'll see a meaningful rally, not a big, but a meaningful rally in the face of all the global worries. But markets are known to surprise. And I leave you with that thought. Let me toss it across to Nimesh, who's, of course, got the pulse of what dealing rooms are talking about. Nimesh, over to you.
No, Prashant, from